What's up, guys? My name is Drew Adams, and in this video, we're going to talk about what it means to buy the dip. Now, jumping into the video, I just wanted to start by thanking you guys by hitting the subscribe button and like button on all my videos. I recently hit 100 subs, and I am so grateful for each and every one of you. Furthermore, I made my first dollar on the channel. Somebody used one of my affiliate links, and whoever you are, it looks like you are a musician. Thank you so much. Hit me up on my social media platform. I'd love to see some of your content and what you are doing. So using those affiliate links below really goes a long way in helping me out with the channel, because the road to 1,000 subscribers seems very long and daunting right now. So thank you guys for subscribing and liking, and let's get into the video. Buying the dip is essentially buying an asset or an investment that is on a decline that you believe is going to come back up. Now, one perfect example of this is what's going on with Apple and Tesla right now. Let's look at these numbers. Jumping into the Apple stock 1 year from today, back in March of 2020, before the crash, it was about $84 a stock, and there was a ton of fear injected into the market when it came to the coronavirus. Tons of people sold off. Apple stock dropped down to about $59 a share. One of the things that you need to realize is this is a great time to buy. When stocks dip like this and you're going long on them, you can see that buying the dip would have been very lucrative. So if you would have bought down here at 60, looking at the price today, it is 121. So you would have effectively doubled your investment if you had bought low or on your way down on the dip. And so this is one strategy that works very, very well for a lot of people, especially if you're going long. One of the things I'm about to talk about now is very, very important for you to understand. Now, the majority of my viewers are between 18 and 44 years old. That being said, most of us are in the position to go long. We have at least 20 years until we retire on the upper end of it. And on the lower end, there's maybe 45 plus years of growth or potential to go long with the stocks that we're investing into. So understanding the long-term play on these investments goes a long way. And so let's do a little rewind and take a look at Apple stock back between the years of 2007 and 2009. If you take a look here, Apple had a sweet run. They got all the way up to $7.25 a share. Shortly after, the housing market bubble burst and it tanked. It tanked all the way down to $3.19. Now that's about a 55% drop or more in value of the stock. Now, if you are taking a look at the short term, you lost your shorts. You lost all your money and you're freaking out and you're not sure what to do, right? And so one of the things that you got to realize is these companies weather the storm, especially big blue chip companies like Microsoft, Apple, Johnson and Johnson. These type of companies are going to push through it. And so if you have a long-term play and you know the business and you understand the company that you're buying into, then taking a couple steps back out of the micro ups and downs of the market is going to help you out a ton. And so because all of us are in the position to go long, we can take a look at these situations of the ups and downs that we're currently going through to have more of a calm mind. We can sleep at night understanding that, hey, things are going to be okay. Now, if we zoom out on this chart here, we take a look at where we're currently sitting today. Imagine buying Apple stock at, $3 a share. It's pretty crazy. You would have an insane return if you were to have bought in the dip during the housing bubble in 2008, 2009. One of the things you got to realize is buying into these dips can be extremely lucrative. Buying the dip isn't a foolproof method, however. One of the things you want to do is make sure that you do your research. One very good thing to do is to take a look at the future projects of the company and see if there's some product that the company is going to put out that is going to increase sales and hopefully potentially increase the value of the stock. Now, me personally, I don't do this with very risky stocks. I do it mainly with the blue chip stocks that I plan on holding forever until the time I retire. And so, that being said, as well, me personally, I'm not an advisor. Don't take my advice or my opinion on this as something that you should do. Don't just go out and buy everything that I buy. But that being said, you want to do your own research with all of the stocks that you buy and make sure that it's something that you're comfortable with, make sure that it's something you believe in, and make sure that it's something that you understand so that you can, with the knowledge you have, increase the value of your overall portfolio. Let's talk for a minute about one of the most iconic market dip buys that has ever happened. One of Warren Buffett's all-time great investments is Coca-Cola, and it just so happens to be that it's the stock that Berkshire Hathaway has held for the longest amount of time. There's no other holding that better exemplifies the investing skill, patience, and temperament than this one. Buffett first started buying shares of Coca-Cola in 1988, not long after the famous Black Monday stock market crash in 1987. By the end of 1989, he had purchased 23 million shares worth $1.8 billion. Warren has rarely transacted in Coke stock since 1989. He added Berkshire's holding to Coca-Cola in 1994, bringing its ownership up to 100 million shares at the time, but Warren Buffett has never sold a single share. The stock has split 2 times since 1994, bringing Berkshire's ownership to 400 million shares that has increased in value, giving Buffett an unrealized gain of about $20 billion. Not only that, but Coca-Cola has paid him a total of $7 billion in dividends since 1995. Having said that, not all of us have $1.8 billion in cash laying around just a drop in the market, waiting for a drop to happen. But one of the things that you could do is recognize when there are big drops and realize that all the money that you put into that market dip is going to exponentially grow for you over the years. And so here's a quick look at something that I did when I saw the market start dropping back in March of 2020. I started dollar cost averaging in with my 401k and some other investments that I have. And here's a couple of graphs. And as you can see here, I had pretty steady growth on my 401k as the market's gone up and down over the years. And then you can see there is a dip last year, March of last year. And that is when I started increasing the amount that I was putting towards my 401k. In fact, I had put a couple thousand extra down because I had extra money, and look what it's done at the tail end of my chart here. It is spiking up past where the natural trajectory of my graph was going anyway. Another thing you need to recognize is that this pattern that is showing in the graph here isn't just a short-term gain in my portfolio. This is going to compound over the years, my working years, until I retire. It's going to keep growing and growing at an exponential rate, and it's going to do really good work for me over the years. So it's not just a short-term gain. It is a long-term gain that's going to stick with me throughout my whole career. One proven way buying into the dip is to look at sectors that are hit hardest during market drops. Now, since March of last year, the tech industry has blown up. Amazon and Tesla are perfect examples of this. When a lot of other companies were hurting, these tech stocks were blowing up. But that being said, there were other sectors that were hit pretty hard, like energy, financials, and industrials. Taking a look at the S&P 500, you can view these sectors that are hit the hardest, and you can start to put your money specifically in different index funds that track the energy, financials, or industrials. This is a great way for you to get into certain sectors, especially if your portfolio is weak in certain areas. You can diversify and balance out your portfolio a little bit better, taking a look at these market dips. And currently, one of the things that we're going through right now is technology is taking a big dip because other sectors are blowing up, because people are starting to feel more confidence in the market, and they're taking their winnings from the tech stocks that they had all through last year and putting them back into a more diversified portfolio. Going back to my example with Berkshire Hathaway putting $1.8 billion into Coke, it's not possible for the vast majority of us. But that being said, dollar cost averaging each month or each week or each paycheck you get into some stocks that you see that may be on a dip or maybe undervalued is definitely one great way for you to buy the dip and get into the market and get some really nice unrealized gains from that. Anyway, that's going to do it for this video. Thank you guys so much for sticking with me to the end. Do me a huge favor, smash that like button. There's some links down below for some affiliate links that I have as far as gear that I'm using in the office here. And there's also some links down there for you to get started with investing if you're not currently investing. There's some free stocks that you get both from Webull and Robinhood. Go ahead and use those links if you're not currently invested but interested in it, as I'm going to continue doing these beginner investor videos so that you can learn how to invest and be the best you can as you grow your portfolio into retirement. Thanks a ton.